Well, it's another interesting day in the markets. Let's look over here. All right, so green across the board, but not so much. It's funny because, for old people like me, you look at 100 points on the Dow and you're like, ooh, 100 points, but it doesn't mean anything anymore. It's only 1/4% on the Dow, 127. You have to kind of adjust your perception of what these things are actually doing based, as they climb and climb and climb. I mean, it used to be once upon a time, 100-point day on a Dow. Everybody's like, oh my God, what's going on? Anyway, so S&P is up imperceptibly. The NASDAQ is up for the NASDAQ imperceptibly too. And the Russell is up a whole percent, and it doesn't seem very exciting, but it's good. I mean, getting back over 2,300. Most notably, though, is if we go to, let's see. Where is the main screen for this stupid thing? Oh, we need this. Oh, and I don't have my watch list on this machine. Damn it. I forgot how to do that. I got to transfer everything over to here. Anyhow, oh, how's oil doing? Oh, very nice. All right. So oil's been a bumpy ride, but we're up. Well, I'm up 1,100 overall because I lost money on the first round and then I made money on the second entry. And we talked about that first thing in the morning, was entering the oil trade. My target is 70.50. Oh, that's over here. So 70.50 is my hopeful target, and that's going to make quite a lot of money. It's going to make 60 times 4, which is $2,400 more if it goes well. Oh, let's look at the oil report. Let's talk about that. There's a good way to start. See, it's great. It's fun having no agenda because then I can just randomly bounce around. And it's up to you guys. You can perfectly, it's perfectly okay for you to ask questions if you want to steer it in a certain direction. But I'm having fun being me. All right, so where are we? The petroleum status report, it's called. Good old Google knows what I want. It's hard it's good. That's why it's hard breaking up with Google, because it knows you so well. It's like it's like an old girlfriend. It's like, oh, you know what I like. Because I do not use the AIs for search. I still use Google for search. Although if I have it depends. I mean, if I want to look for something like the petroleum status report, I will use these because the AIs don't really pull up things the way Google does, and so you can click on it. So if I intend to click on a site or go somewhere, I use Google. But if I have an actual question, I would never ask Google. It's just pointless. So so here's the petroleum status report. Let's blow that up a little bit so somebody besides me can see it. All right, this is nasty. Petroleum crude oil inventories increased by 8.7 million barrels from the previous week. And gasoline increased by 2.2 million barrels. So nobody wanted oil, nobody wanted gasoline, and distillates up. Oh, distillates decreased. Sorry. So it's not terrible. I thought it was an increase all across. So at least people wanted distillates. Oh, but you know why we had a draw on distillates? Because this is the season. This is when they start turning over the refineries. This is when they start. In the spring, they do refinery maintenance, and that means they take down the refineries, and there's less refining capacity. Oh, and you can see it right here. Look at that. So last week, refining capacity was 88.6, and this week it's 86.4. That's a big difference, obviously. So if the output per day, well, how much is it? It's 2%. Basically, it's 2%, 2.5% less. So if you look at 20 million barrels a day of refinery output, right? So that's what this is, product supplied. So 20 million barrels a day times 0.025 is 500,000 barrels a day of, so there's 500,000 barrels a day less being refined than there was last week because the refinery capacity is lower. And the input dropped also. Well, of course, well, if you haven't got the capacity to supply it, then the input drops. So if your input to the refineries drops, then therefore you're going to have more of you're going to have a build of barrels, assuming the same amount of barrels comes in. And gasoline production, for whatever reason, was higher. Distillate fuel production was lower. And that's how you get these variables. Overall, though, what happened? The big fact of the matter is that the overall inventories grew from, they fell from 08 to 05 because all other oils had a significant drop, and that's not measured in this report. So on the whole, nothing spectacular to report. Petroleum products exported, 4.7 million barrels a day still being exported. That's massive. That's 20% of our total products are sent to other countries every day. And the other thing you learn from these reports is oil last year was 72.72, now it's 72.84. Gasoline was more money last year, now it's 308. So what does that mean? That means that the refiners are making less money now than they were last year. The price of oil was the same, but the price per gallon fell on gasoline. So the refiners are making less. That's why they're sending so much of it overseas. They're not making enough of it. They're not making enough in this country. So they are seeking better markets. Anyway, so the bottom line is there is a build. The dollar and the dollar weakness. The other reason I get brave about doing a short here is because the dollar, which we don't see, let me put it up here. Wait, how do we do the dollar? Dollar. Why are you not showing me? Oh, because of the thing. Dollar, dollar, dollar. How about $ USD? Nope, didn't like that at all. DX. Damn it. Oh, I gotta look on my other computer. DXY, son of a bitch. So it's DXY. Oh no. There it is. Okay. Oh, back. All right. So the dollar has fallen off considerably, and oil is down too. So the dollar is weak and oil is weak. So if the dollar bounces, and it's much more likely the dollar is going to bounce off of 107-ish. This is a little low for the dollar, so it's more likely the dollar is going to go up, and if the dollar goes up, that's going to put more pressure on oil. Can't believe it's February 5th already. It's crazy. So we will see how this goes. Now at this point, there should be a stop here, which is 71.15. So I guess just to alert us, I should set a stop where I buy back one short at 71.15 and one short at 71.20. All right, so out of 4, I'm setting up to buy back 2 if they trigger. So if it bounces back up, I'm going to buy them back. If it doesn't bounce back, they're going to stay open. So I'm hoping this line holds at 71.15 and that oil keeps going down to my 70-50 target. But just because you have a target doesn't mean you're right. So you always have to think like, well, maybe I'm wrong. What should I do? So back to currencies. Look at that. See, that's what's happened lately. From 109.50 to 107, let's say 50, the dollar's fallen. And now to check our premise, we want to see on a longer term, where is support for the dollar? There's definitely support at the 107 line. And now we pull back a bit further. And we see that if 107 fails, they're in big trouble. So the support for the dollar is at 107. The fall is from 110. And this fall is from 109.50. And what does that mean? That means you have a 3-point fall. And then what do you do to check the bounces? You're going to take 20% of the 3 points. So it's going to be 0.6. And those are your bounce lines. So 107.6 is your first bounce. That's going to be pretty significant. That's going to drive the markets pretty far down. That's going to push the markets lower because 107.6 is a big bounce from 107. So it's going to be a big push. Right now the dollar's down 0.5 point and lifting everything, but if it comes back up, it's going to put a lot of downward pressure on stocks which are already weak and the commodities that are already weak. So that's what you got to do. You got to look at all the different cross currents and see how things are. So in the indexes, these are days. The Dow's double topping, right? The S&P double topping. The NASDAQ double, triple, whatever topping. And the Russell isn't even coming back to where it used to be. This is not really great. These are not great charts. Look at the Nikkei. The Nikkei already got rejected and came all the way back from 45 to 38 something, which is stupid numbers. 38.8 from 40.5. So like 2,000. Let's call that about 2,000 points down, which is only 5%. It's not gigantic. Now Europe and Germany haven't really come back at all. They're still on their sugar highs. And the VIX has come down a bit. Uh-oh, there goes oil. See, that's what you set those up for, so you hear it. All right. I'm thinking probably just kill it. I mean, it's up 1,100. It's up 1,000 for the day. So we made that call early in the morning. And then we had the inventory report, and it went the wrong way at first, and then it went the right way, and never had to look back again. So there's still 3 short. This didn't trigger. But I don't like the way it looks. I don't like the way we're bouncing off of 71 here. And especially since the fall is from 72 to 71. So now I divide my dollar by 5 segments, 20%. So it's going to be 20-cent bounces. So the bounces, that's why I put 71.20 as a stop. The bounces, if they're going to get rejected, are going to get rejected at 71.20 as a weak bounce. But it's very easy to hit a weak bounce. So we shall see. Now, we're supposed to check on Brent. So now I'm messing up all my charts so I can just look at oil, which I don't like to do. All right, so Brent. And remember I said if Brent goes below 75, then we're in good shape on our oil short. And so in theory, unless Brent goes back over 75, it could stick short on oil. But on the other hand, it's going to fail. I can see it's going to fail. On the other hand, if I wait this long, that's going to be 25 cents from now, and I'm going to lose a huge amount of my gains. So I'm kind of not into that. I'm kind of into stopping out. And here it goes anyway. Let's see. Yep, there goes another. Now I got 2. All right. I'll tell you what, because I'm going to be busy, so I'm going to just put one way up here. That'll be my final stop out. Still come out close to 1,000 for the day, even if that does stop out. That's going to trigger any moment. All right, where were we? Enough worrying about my stuff. So Europe. All right, so here's oil failing. That's a pretty critical fail. Look how long it's been over that line. It was a solid support line, and now it failed it after only a small bounce. Oh, and that's a good point. What kind of bounce? What is this? Oh, too long. Oh, sorry. I'm going to go out further. So I think there's a case to be made that 82 is the right line. So coming down from 82. See, 80 is the real, is a definitely strong support line. But you look at all these things, and 82 has been very, very, very consistent over here. So there's certainly some sort of a, see down here too. So 82 seems pretty significant. Really, it would be 82.50. But yeah, and you can see earlier it was 82.50, but it kind of deteriorated a bit. And I would say the fall from here is 82. So let's say 82 down to 75, and let's assume that's an overshoot. So if we go from 82 to 75, that's going to be $7, and then times 0.2 is $1.40. And so, you're not going to have a bounce on Brent until you hit 76.40. So back from 75. So in other words, 82 to 75 is $7 down. That means your bounces are going to be 140. So you're going to have one bounce. The weak bounce is going to be 75.40, and the strong bounce is 76.80, which is let's go back to the hourly chart. So 75.40 is your first bounce, and you can see that there's a little bit of support on the way down, and then 76.80 is not very significant. That would be the strong bounce line, but it hasn't been very significant. Interesting. All right, but that's how you figure out the weak bounce and the strong bounce. But the problem is, since the weak bounce is so high, that as soon as we cross 75, we're in trouble because it can go up pretty fast. How many of these things do we got left? We still have two short. Oh, that's interesting. Didn't trigger yet. So that's energy. Then we look at bonds. Bonds have had a huge recovery. That's a nice bounce off of, I mean, the low is down here. And again, it's the same thing. The 10-year note is the most traded, so you want to look at that. And the 10-year fell from 115 back to, yeah, that's a toughie. I think I would call that 108. So the same thing. So now you have 7-point fall, 140 bounces. So what would the two bounces be? It would be 107 and then 108.40. I'm sorry, 108. I'm sorry, 10. If we're using 108, it's 108 and then 109.40 is a weak bounce. Okay, so that's right here. And isn't it funny how, look, see that? That's the weak bounce line. That's a confirmation. When you see that support and you see it here and you see it here and you see it rejected here and you see it holding here, that's good confirmation that this is the right line to be using. So 109.40 is the correct weak bounce line. So then over that is going to be 110.80. And we'll look at 110.80 and see if that worked out. Nothing major, but 110.80 here, 110.80 here, right? That's the support area. 110.80 up around this area. So not as significant as the weak bounce line, but the weak bounce line is here. So between anyway, so bottom line is that's a weak bounce, that's a strong bounce. Once you're over the strong bounce, then you start looking the other way at the retraces. But all we have at the moment is a weak bounce on the 10-year note. Talked about coffee today. Coffee is out of control. Look at that, another 17 points today. Holy crap. See, and I know that because when I go down to the cafe downstairs and I hear everybody bitching about the price of coffee. While they're paying $5 for a cup, they complain about the fact that the supermarket coffee went up. Like a pound of coffee at the supermarket is like $17 now or something crazy like that. It used to be $8. And people are all bitching about that. But meanwhile, they're sitting there at the cafe drinking like a thimble full of beans for like $5. People are just insane. Oranges came down a lot. Interesting. Lumber all over the place because of the tariffs. Everybody freaked out about the Canada tariffs, and that went off. But that lets you know that if we start getting pissed off at Canada again, then long lumber is a good play. Gold, are we there yet? Gold is almost 2,900. It tested 2,900 this morning. The silver's testing 33. Notice that's like a triple top at least. So 33 did go up to 34 to actually hit 35 before it pulled back. And that is the range we're in, the 30 to 35 range. And that means 31 is a weak bounce, 32 is a strong bounce, 33 is now a strong retrace. Once you go past the strong bounce, you now flip the chart and now you're looking at the retraces instead. And so 33 is a strong retrace, 34 is a weak retrace, and 35 is your goal. So once you get over a strong bounce, you start looking the other way and say, oh, it's not a move down, it's only a correction, and now we're back onto the path for the retrace. And once you complete your retrace cycle, then you can be bullish in the next cycle. This is all called the 5% rule, by the way, in case you guys are new. And why if you go to the education section, there's some information on that stuff. Because it's a lot. It's not like something to easily explain. Look at rice got cheap. That's a good thing. Corn got expensive, crazy expensive. And we already talked about currencies. How's Canada's currency? 70 cents to the dollar, you poor bastards. Holy cow. Oh my God. 1 Canadian dollar by 70 cents. That's not good. Oh, that's not what I meant to do. And the yen is also in terrible shape. Canadian dollar, that's horrific. The euro is only $1.04. It used to be $1.30. I mean, not too long ago. Last time I was in Europe, it was $1.30. And the Great British Pound is 125. Last time I was in Europe, there were no British pounds. That was before all that Brexit nonsense. Anyway, so what were we going to do? See if there's any questions. No questions. No questions, so I get to keep on rambling. Ooh, this Led Zeppelin movie's coming out, like the history of Led Zeppelin. Definitely want to see that. That's when I said the word rambling, it triggers that reference for me. So yesterday we were looking at some trades, and this morning we're looking at some trades. And let's start off with yesterday. I'm going to talk about earnings and again, we're going to have another one of our trade selection process. Wow, this is a little too blown up. Control minus. There we go. So we're still in the same place. We're still around 6,000. Notice that 50 DMA, 50-day moving average is climbing. It's going over, and if it goes over, you have to think of the effect of the moving average going higher than what we were calling the top of the range in the 6,000 line. That should effectively strengthen, should effectively strengthen the 6,000 line, so it becomes a very serious support. The 200 DMA crossing over 5,600 makes that a very, very serious support. And now that's key, because that then dictates what we're going to think about for the future, because that's a strong retrace. What is a strong retrace? It means that you're still bullish. This is a weak retrace. In other words, doesn't matter if we go back here, this is not a pullback. So this is a weak retrace. But if you hit the strong retrace, that's getting to be a serious pullback, and you have to start worrying about the consequences of failing the strong retrace. You can easily go much lower after that. But if you hold the strong retrace, you're still consolidating for a move up. Anything up here is consolidating for a move up. Anything down here could be consolidating for a move down. Not 100% like this wasn't. Because why? Because the weak bounce line held. That was actually a bullish signal when that held. But now it's the same concept as the 50-day. The 200-day moves over the strong retrace. This should now become a very hard line to cross, because you're going to hit huge support at the 200. That's going to wear off what's effectively going to happen is the support at the 200-day moving average. And this is the average at which people bought the S&P. Damn it, there goes. Yeah. I knew it. I don't want to go. I don't want to lose much more money than that. So we're out. That's it. $1,000 for the day. I'm happy. 950. I would have been happy with 1,000, but I was greedy. I tried to get some more out of it. So strong retrace. You want it. The 200-day moving average means that of all the people who bought stocks over the last 200 days, their average decision was to buy at this line. On the lower end of the last 200 days, the average of all the people, 200 days is 200 stock market open days. So that's a year basically. So since last year, the average person who bought in the market bought in at that price. That's where hundreds of billions of individual trades decided the market was valued at. Hundreds of billions of them every day, several billion, 4 billion, 5 billion on the NYSE, and whatever ungodly amount of money that's being traded and so on and so forth. So all those aggregate trades, all those decisions, every trade made by Goldman Sachs and JP Morgan and Meryl Streep, and every trade your grandmother made in her 401k or IRA, and whatever your kids have dripping in on their work portfolios, every decision, all the trades, all the money, everything picked this number for the last 200 days, and it's rising, so therefore the momentum is up, right? So that's going to be a tough nut to crack. It's always hard to fall below the 200-day moving average. So since we're at 6,000 and that's 5,600, that means there's only 400 points to fall. 400 points is not very much. It's 6.6%. So no, it's not, is it? Ow. Maybe it is. 400. What? 400 divided by. Yeah, 6.6%. I'm right. All right. I hate it when I doubt myself and I'm right. It's annoying. Sign of aging, I guess. I used to assume I was right. I used to say that. I used to be, especially with numbers. I'd always like say a number and I'd be right, and people would be like checking at me. How could you have gotten that number? I'm like, I know my numbers. I sit there very smugly and annoy people at meetings and be like, yeah, I knew that. And they sit there for like 5 minutes trying to confirm the number I hit off the top of my head. But these days, nope, I second guess myself. Very sad. Anyway, so 6.6% is our correction zone. We don't think we're going to fall much further than that. And we're hedged for a 20% correction. That's just not going to happen. So I gotta think about our hedges and think of whether we're over hedged and possibly move them so we're actually hedging for a 10% correction and not a 20% correction. So we have to, there's a whole process to doing that if we have to start thinking about it. But if we hold up through earnings, I don't see that I can't see a real good catalyst to take us below 20%. But even the trade war, even starting trade wars, I didn't really get the negative reaction we thought it would. Of course, it ended right away, but you know, it doesn't seem like we're going to just completely crash out, not over earnings, not over trade and tariffs. There's not, you know, what's going to really take this market down? We already have bird flu breaking out all over the place. It's the next pandemic, and we don't seem to care about that. Ooh, look, Bitcoin's 97,000. That's collapsing. That's a big fall. It's down about 1.5 points today. So anyway, so as it looks like we're in this zone, we are probably in this zone. So 6 point, you know, about 6% up, or yeah, about you know, this, you know, two lines up anyway. So it'd be 400 points up and 400 points down. So we can get to 64, and we'll redraw lines. And then what will happen is this line will go blue, these lines will be red, and these lines will be green. And that'll be the new range. So we'll be, you know, so we'll expect the range to gyrate around here. But no longer this ever upward trajectory. We're kind of past that. That's not going to keep happening. And that means we have to adjust our trading expectations accordingly. Although we mostly already have in our portfolio, so I don't think that matters much. Anyway, oh, so this was just the beginning of Tuesday. See? You see how you see how I get everybody prepared for what's going to happen? All right. And here we looked at the sectors. This is good too. I don't know if me making it bigger here helps. Let's see. Well, I don't know. So, you know, this is since the election, so in the last 3 months. NASDAQ up 7, Dow up 6, S&P up 5. Russell, I think that's the Russell, but that's about right for the Russell is too. It's lagging. Oh, I can show you that live actually. Here. This is I don't know if you have to, I think you might have to subscribe to get this, but if you're on FinViz, this says elitefinviz.com. But anyway, so you go here and I say performance of 3 months of the not the S&P 500, of the ETFs. So you see how that works? So what is RSP? S&P equal rate ETF. No, that's not it. Where's the Russell? Dividend, leverage, large cap, value, mid cap, small cap. Oh, there you go. So I don't know. I'm sorry. The Russell's up. The Russell's up almost 5%. It's really not doing any worse. So notice the Russell's up 5%. TZA is the inverse to the Russell, that's down 16%. And TNA is a 3 times. See, now that's a ripoff, right? Because TNA is only up 8% with the Russell up 4%. So that's not doing its job at all. That's a very poorly constructed ETF. And here's, oh, IWN, Russell Value ETF. There's a lot of ETFs. But you look at KRE, the regional banking, doing well. XLF, all banking is doing very well, actually. You know, and FAS is a bearish. Wow, it's down 28%. But that's correct. That's what it should be down. And FAS is up 29%, and that's what it should be down. Oof. That makes this a good hedge on the banks, probably. It's all the way down to $5. So what's going to happen to FAS at $5 is they're going to reverse split soon. So you don't want to jump in that right now. But they are going to do a reverse split because once it gets below $5, it starts going to zero very quickly. And why is that? It's because these ultra ETFs are fee churners and they wreck your portfolio. It's use them very judiciously. The reason we use them in the short-term portfolio is because we're selling the premium, and so we get an advantage. We sell a lot of the premium in the ETF. So although we're using it as a hedge, we also sell a lot of short calls, and those get chewed up and wrecked, and we take advantage of that. But to buy them naked is never a good idea. Here's emerging markets are not doing, you know, look at the other parts of the world. Emerging markets not doing well. China generally not doing well. The more developed European markets, developed markets are doing okay. This is corporate debt, not particularly great. This is crypto, up a lot, 40% since Trump got elected. That's pretty damn good, right? So it's been great for the crypto bros. Gold is up 5%, so it's really going up with the indexes. The stocks, of course, took a hit recently with this nonsense going on with NVIDIA and DeepSeek and all that. So that's where that chart comes from. I said here and now it seems like NVIDIA is going to be invested. So NVIDIA is being investigated by China now for monopoly whatevers. And but this is what happens, you know, when you run the government the way Trump is running it, which is just, you know, just randomly declare investigations on people you don't like, and it's like, yeah, you know, we'll investigate them first, and I'm sure we'll find something eventually. You know, if we dig into it, we'll find something wrong. Then you invite retaliation from other countries doing the same thing. You know, there's a reason we have World Trade Organizations and the UN and so on and so forth. It's so people don't do this sort of thing. And so you agree that there are certain rules that everybody follows, and you don't use different countries' corporations as pawns in your geopolitical schemes, because it had been agreed for decades that you know, economic cooperation, corporate cooperation should not be attached to the governments. And yeah, I'm sure a lot of people are like, well, China did this and China did that. Did they? China got accused of a lot of stuff, but did they do it? What do we actually know for a fact? Facts are very elusive these days. You know, is TikTok spying on you? Facebook is definitely spying on you. Is TikTok spying on you more than Facebook? Can you be more invasive than Facebook? You guys have all had experiences where you've talked about something and then you sit down at your computer and there's an ad for it. That's insane. That means Apple or Samsung or both or whatever, or your TV set or your iPad are listening to you, or your Alexa. They're listening to you. And when you say, oh, maybe we should go to Killington this weekend, and all of a sudden I sit down and there's an advertisement for Killington on my screen. Why is that? How, you know, it's, you know, you could say it's useful, which is really what the kids say about TikTok. They're like, well, we want them to know everything about us so they can give us good videos. That's the whole point. It's a trade-off. They're like, open yourself up to us, expose every detail of your life, and we will reward you with videos you really enjoy. I frankly can't stand TikTok. It's just, It's just below my attention. That's my attention span is not short enough to enjoy TikTok. I just can't sit there and watch these stupid little things. I do like Reels though. The Facebook one, Reels, has better content, although as I watch Reels, I get the impression that they're fake, that these are not genuine people. These are paid professional bloggers doing it, because there's too much similarity between them. The quality is too good. The way they do the wording. Maybe I'm wrong. Maybe it's so easy to be high quality in Reels that everyone seems like a professional. But the problem is, to me, everybody seems like a professional, and the editing and the cutting and the pacing and the sound quality, it's too even. It's too good. So my theory on Reels is that Mark Zuckerberg has hired thousands and thousands of people to constantly feed in these Reels. And whereas TikTok seems to be more genuine, like just people doing stuff. And they rise, they rise through the ranks like a YouTube video used to, which you can't trust those either anymore. But they rise through the ranks, and it's a meritocracy of some sort, which is what kids believe is true about TikTok. Now, if it's not true, then expose them. Well, they'll expose them where? Because all the kids are watching TikTok. They wouldn't know. But that's my theory of Reels. It's too good to be believed. Do I even have Facebook up here? I don't, because I don't really like it. I don't like Facebook, but when I watch Reels, which some people send me them, I get, TikTok. If someone sends me a TikTok video, I'm annoyed that they sent me a TikTok video, and I watch it, and then I go, ugh, I'm so sorry I watched that. That's my general reaction to TikTok. On Reels, if somebody sends me a reel, I'm like, oh, wow, that was good. And then I go to the next one, and I'm stuck in Reels, and I wasted a half hour before I get myself out of it. So that's why I believe Reels is fixed somehow. It doesn't make sense that it could be the quality of content on Reels is just too much, and also too tailored to what you're interested in. To me, it's better than TikTok, but that just might be because I don't spend any time on TikTok. Where were we? Anyway, Merck. No, we weren't on Merck. We were on NVIDIA. Right. So NVIDIA has been having a bit of a rough time, but only coming back from 150 to 115. Not terrible. And 150 to 115 is 35 points, and therefore you're going to look for 7-point bounces. And what does that mean? That means 122 is your first bounce. That's a weak bounce. And then 130 basically is your strong bounce. So when it goes back over 130, then you're recovering. Until that, it's not a recovery. So we'll see what happens. But a big move up today, big 3.3% move today. But the thing about NVIDIA is, I'm surprised, by the way, because I think this is sort of being manipulated, because look at the volume, right? So I think that this is being manipulated because this China news that they're going to investigate NVIDIA, they want to show that this isn't bothering the stock. But why would it not bother the stock? That doesn't make any sense. It's a pretty serious issue. And poor Google. They're down 7% for the day. And I see how Google's falling on big volume, right? And NVIDIA is on no volume. The volume on NVIDIA died. Look at this. It sold off a lot, big volume, went back up, volume shrank, down, volume shrinking. And this is crazy. Why is it so low? I mean, it's only 145, but still. There's a huge drop off in volume. And so it falls on big volume, comes back on low volume. That's very suspicious activity. So I would be very, very careful about this. This is not really a bounce. Anyway, so that's where we were there. Here's Merck. We sold puts on Merck yesterday because it was kind of nice and low. I don't know what happened to it today. It's going to be a long thing if we keep going back and forth like this. Merck. Nope, still down. So I don't know, 90. 90 is better than yesterday, right? See, now this is a flaw I find in candle charts is why is this a green candle if it fell? See, it's green from open to close. That's what that means. It's green from open to close, but it's tremendously down from the day before. Green just doesn't seem to be the right descriptive color, but that's how candles work. It's not about whether it's up or down. It doesn't matter where it is from the day before. It matters where it is from the start to the session to the end of the session. I mean, there is some value in knowing that. So in other words, a red candle means that you finished lower than you began. A green candle means you finished higher than you began. But it's each day by day, and it doesn't tell you it doesn't tell you whether the stock had a day where it opened and closed below. So you can have a green candle like this, or this little thing. You can have a green candle, even though it's clearly below the day before. You can have a red candle, which is clearly above. Here's one. Here's a red candle, clearly above the day before, but it finished below, and that's the end of that. That's how the candle goes. So you gotta understand the chart more so than just looking at the candles and figuring out what it does. But the bottom line is open. It's from the open to the close. So if it's green, it opened here and closed here, and if it's red, it opened here and closed here. And then the sticks that come out of them are the day's high and the day's low. So I like candle charts. They're kind of informative about what happened during the day, but that's my pet peeve on them is this is stupid. That there should be something else. Because that's a bad day. But anyway, Merck, roughly 10 times forward earnings. So yesterday, while it was down, we took advantage and sold puts basically, and we changed the position around that we had and did some fun stuff. Well, I did it right here. I said we will take advantage of Merck's downturn to sell some short puts, 2027.90 puts for 12, which nets us in for 78. Because yesterday people were panicking. So MRK 2027, all of them. And so now the 90 puts are $11 basically. And yesterday they were 12. So we got an extra buck out of them by doing it, by jumping on them yesterday, we got an extra buck out of them. That's nice. So we're in for a decent price. And Pfizer, I said about Pfizer, it's, they just confirmed earnings were good. Everything looks good. This is just a slow train leaving the station. And so we jumped on Pfizer also and did something with them. Because Pfizer is such a big stock, although not anymore, not in today's trillion-dollar, multi-trillion-dollar market cap world. But try, Pfizer is a $150 billion company. Used to be impressive. No longer that impressive, but it used to be impressive. And how's Pfizer doing today? Probably. Yeah, so Pfizer's up 2 points. It's up more today than yesterday, but yesterday's the day they had the earnings. And that's because people don't know how to read a frickin' earnings report. I don't. It's like going to the track and betting, but you don't understand a thing about the racing sheet, right? You get the racing sheets at the track, and it tells you about the horses and the jockeys and how they've done and what their speeds are in certain conditions and so on and so forth. It helps you make a kind of educated guess. about what the horse is going to do, and it doesn't. And frankly, I mean, believe me, and people lose their minds at the track too. But it's better than nothing. But people play the market as if they're at the track with no knowledge of the horses. But you're betting and they're betting incredible amounts. It's not like you're betting $5 on a horse. You're betting $50,000 on a stock, and people don't understand what an earnings report looks like and how to read it. The earnings report is like that track report. It tells you what the horse is doing and what the chances are and how it performs in certain conditions and how it's going to likely perform today, or in this case, per quarter or whatever. But it's amazing how few people know how to read it, including 90% of the analysts out there. 90. It's being so generous. I'd say 90, minimum 95. That's 1 in 20. I couldn't name 1 in 20 analysts who understand how to read an earnings report properly. It's insane. And so we have a blast during earnings season because we know how to read a report and pick a stock and say, look, this stock's going. That's exactly what I said yesterday. Pfizer is leaving the station. It's like a train that's pulling out. But I think, what did I say? I know I said something just about that. What did I say? What did I say? Oh, as to Pfizer, the train is leaving the station, but it's a big, that's what I just said, but it's a big $150 billion slow train, and you can still jump on it before it pulls away. We read the earnings report. We said it was good. It was going to start going up all day long yesterday. It didn't go up, even though everybody read the same earnings report I did. It's horrifying. It really is. I don't know. It's like, because you know what it is? It's so bad that it's almost like this is not a profession. You know, it's like being a good magician. You know, if you're a good magician, it's really good. Like, you know, if you're a Las Vegas good magician and people are amazed and you do stuff that's unbelievable and things like that. Whereas the other 10,000 magicians you're going to see in your life suck. They, for the most part, are not good. They're using like tricks that come out of a box that aren't very impressive. And so do you call it a profession when almost everybody in the profession doesn't know what they're doing and only 3 or 4 guys actually know what they're doing? That's the problem with this stuff. And the issue is that people treat this like it's voodoo or something and that you can't know these things. But of course you can know these things. There's facts, there's hard numbers, there's data. You got to learn how to read it. Pfizer is also trading below 10 times forward earnings. They pay a 6.4% dividend, and that means there's many ways to make money trading Pfizer. I don't know what else they can say about a company. I've been saying it for God knows how long about Pfizer too. Ugh, I didn't sign in. You think I'd sign in? You think there'd be an automatic sign in? All right, Brian. Hey, Brian's got a question regarding Whirlpool. Basically, he's saying they sucked. What are your longer term projections for them? Can you take us through the process to determine a fair value estimate? Oh, okay. All right. There you go. All right. Whirlpool. All right. Here's what I want to know. There you go. I'm just going to check it with the AI. Save me some time. All right, we'll get back to Whirlpool in a minute. Find PhilStockWorld. And where were we? We were here. All right, so Whirlpool. Alan, what do they look like right now? We stuck with them. I know that. I mean, I know our decision in chat after earnings was to stick with them. Yeah, see, they're coming back a bit. Earnings were here, and they fell off a cliff. And we talked about it in chat, and I said, I'm sticking with them. I think they're fine. I mean, it's just they're going. I mean, they're fine if you're a long-term horizon. They're not fine by themselves. Let's see what the report looks like. Revenue forecast to decline to 15.8 billion, below the market expectation of 16.2. Now keep in mind, okay, what's the gap? It's down from 15.8 to 16.2, or from 16.2 to 15.8 is only $400 million out of 16 billion. That's not much. The 2.5%, I think. EPS is projected at $10 for 2025, missing estimates of 11.59. Now that's down 15%. That's 15% down from estimates, but the estimates weren't good in the first place, so they wouldn't be trading at 10 times earnings. $100 is 10 times 10. So free cash flow, $500 million. Revenue projected to reach 16.26 billion in 2027, with earnings of $730 million. They're reducing their stake in India, positioning for U.S. housing market recovery, and that's what's killing them is the housing market. It's not like Whirlpool's a bad company. It's that nobody's buying houses. If nobody's buying houses, they're not buying the new washers and dryers and refrigerators that go into the new houses. And so that's a huge amount of sales because Whirlpool's sales depend on new houses more so than replacements. And why is that? Because their damn stuff lasts so long, because you can have a freaking refrigerator for 20 years. So the replacement cycle of once every 20 years, that replacement cycle on 100 million houses means that they expect a certain base turnover, but their bonus money comes from new homes. That's their bonus money. They're always going to have that same cyclical turnover, more or less. But also another problem they have is in a recessionary economy, people put things off. And one of the things they certainly put off is they put off getting a new fridge and a new washer and a new dryer unless they absolutely need it. And that hurts them. That's you know, it's durable goods, but it's somewhat discretionary when you buy it. Same thing goes for furniture companies. How often do you replace your couch? When do you get a new chair? You know, there's time in good economic times, people are more inclined to freshen up. Remember when we used to get a new car like every 3 years minimum? You know, like that's why leases were designed for 3 years, because basically every 3 years people get a car. Now people have cars 5 and 7 years. People are signing 7-year not 7-year leases, 7-year purchase agreements on cars now. And there's good reasons for that, though, because cars generally will go fine for 5 to 7 years, and there's no sense in jumping in and getting a new one all the time just because it's pretty or a different color or whatever. You know, I mean, I know I used to do it. I didn't think it was unusual. I think most people did it. My Jackie is going to be, oh God, tomorrow. Jackie tomorrow is going to be 23. And she's only had the one car. She's had the same car since she learned how to drive. So that's 7 years. Didn't want a new car. You know, in fact, I objected. I objected the last time she put money into repairing it, but she loves her car, so she doesn't want a new car. And I said it's stupid though. I said at this point it's cheaper to kill it. I said it's costing too much money to fix. My mentality is get a new car and let the warranty cover it, and you know, it's a little bit more money, but I'd rather have a nice new car and drive it. I don't know. I just have that attitude about cars. And Maddie never learned how to drive. She lives in Philadelphia now. She never actually learned how to drive. She's a city girl, and never got into it. It just didn't interest her. Very funny thing. My brother Neil was the same way though. I wonder if it's genetic because my younger brother Neil, he's my half brother and he's 13 years younger than me, and he lived in Queens with my dad and my stepmom, and he did eventually move to California. He didn't learn how to drive until he moved to California when he was like 35. Never drove a car until then. So I was not impressed with Maddie because I was used to it from Neil. I was like, okay, if you want to be a non-car person, that's fine. But it's weird. But anyway, so that's what blows the curve though, right? People don't replace and so on and so forth. And the hybrids are even worse because they don't break down as much as the old cars. That's why Trump wants to get rid of all these things. You know, especially the electric cars, they don't break at all. There's hardly any moving parts. So anyway, so the bottom line is Whirlpool is certainly worth more than that. Here's a horrific. Now, when you're reading a report off an AI, I've got my sources, so I can look here and say, where do you get that one? Now I can decide if I think this source is relevant. This is tip ranks. See, now they've got a 115. I don't know where he gets this number. Oh, I see, because, oh, stupid thing. Anyway, so there was in tip ranks, this wasn't tip ranks estimate, this was the lowest estimate on tip ranks. So comparing the industry fair value consensus based on valuations. So he sees support at 100, which is where we are. And he's saying that, so somewhere between 115 plus is where you should be looking for it to be. And I agree with all that. What are the risks? Declining revenue, margin pressure from inflation, high debt levels, housing market uncertainty. Yep, all true. Catalyst, cost reduction initiatives, housing market recovery, interest rate cuts, and international market growth. I don't know about the international market growth. I don't know if I agree with that. But also think about that. So you've got the Fed generally is heading towards lower rates, makes these things more affordable, and that's what happens. See, when you get a recession and these companies have to batten down the hatches, they cut costs, but then the business comes back and they're running a leaner and more efficient machine, and they actually do better coming out the other end of a recession or a pullback like this. So yeah, that's my general opinion, as well as this one's the AIs. Let's see. Oh, and then Brian said, interesting, you said their bonus is new housing, but what about new apartments here in the Midwest? So yeah, well, that's housing too, yeah. Sure, apartments. I mean, if they need a washer, if they have a washer and dryer and a refrigerator, then a certain percentage of them is going to be Whirlpool. What is WHR's market share? Market share in the US for their major appliances. How about Europe and Asia? You know, while you're doing all this work for me. You know, it's funny because you wouldn't. It's abusive, right? Because I wouldn't ask my own assistant to go out and do it. I'm like, hey, I'm just curious. Go tell me. Go do an entire research project on this for me. See, but there's an example of something I wouldn't want to Google. Because Google, I'd have to go look at like 10 different pages at least to figure it out and compare things side by side and blah, blah, blah. And meanwhile, this guy's going to do it for me. Oh, wow, he's already done. Whirlpool holds approximately 16% of the major US appliance market. So they're around with Samsung and GE in Europe. The company's divested most of its European. Whirlpool now owns 25% stake in Beko. Transaction. Well, who knows what that means? That's not a particularly good response. Whirlpool, one of the major players, but relatively smaller market share than compared to the US. How about an actual number? Hey. How about some definitive numbers, please? So #1 share, the company holds #1 share position in major domestic appliance businesses for both North and South America. So that's where their concentration is. Okay. Combined back over based on 52 billion, 5 point. All right, there you go. Asia Pacific. Total market expected to grow at 4.9%. He doesn't seem to have a good breakdown on what Whirlpool actually does. That's a shame. So see, I would have to start doing the research. That pisses me off. But yeah, you don't get, you're not guaranteed to get all your answers from AI. But anyway, so their major market is the US. That's now, of course, that's good though, because they're not relying on European and Asian markets, and therefore they shouldn't be hit too hard by tariff nonsense. Although then you have to find out, where do they get their parts from? Are their parts American built? So where does WHR source its parts? We are worried about tariffs. And this is the same crap I would have to do manually anyway when I was checking out a company. I'd do the same things, just I wouldn't have to have anybody to ask. I would just have to sit there and look it all up. And of course, if it's spotty, this is why I like it to show its work though. So if it's spotty, we don't know anyway. Global manufacturing footprint, Mexico and China recently reduced its, we said that. Component sourcing, high quality electric control boards primarily produced in the US, plastic and metal sourced from multiple countries, dual sourcing strategy implemented for critical components. Cost reductions, reduced parts complexity, dual sourcing, steel tariffs increase US prices, raw materials cost rose, supply chain disruption. So it does sound like tariffs are going to be good for them, actually. All right, so that makes them a good, I think they're still a good long-term hold. That's the bottom line. We like them. So where were we? This is Warren's report for the morning, running down the news for us. And this was Anya's report. This is very good, actually. So she's doing he's giving an overview, and then she's getting into like the nuts and bolts of what's actually happening and what it means and how it's working. Very good report. This was just some basic news. Soil moisture percentile. Look at poor whatever that is, Delaware or something. So Washington, D.C., Delaware, Maryland, down around there is terrible. They're as bad as California. Down here in Texas, so that's soil moisture. So the places that are really bad in the country are red. This whole area here too. Here's PayPal. They got a big hit. They got whacked. Here's NVIDIA we talked about. Here's the play we did on Merck. We sold the 100 puts in the end for 17 because, I wanted to be more aggressive. Well, that was smart. And the 100 puts are now 16 something, 1650, 1640. And then we took this whole spread on Merck because it fell to a point where we decided the value was there, and that's when we pulled the trigger. Then we and then because we started shopping, and this is what I want to talk about. Here's where we are. So GM, they beat, but they sold off more anyway, and we said, well, that's silly, and we jumped in here. Oh, I'm sorry, we didn't jump in yet. We want to jump in, and this confirms so far that it's going well. Let's see. Yes, they're drifting along down here, but we're going to pick up some GM. Oh, and I had Zephyr and Bodie both analyze these things. So, you know, he talked about GM. He said the price is down 12%. Mixed Q4 earnings and guidance excluded the impact of tariffs and Mexican imports. The market reacted negatively to the uncertainty of the tariffs. There are concerns that the company's ability to compete with Tesla and EV. The company reported a net loss in the cruise unit, which is robo-taxis, larger than expected. Why it's unfair. The sell-off is likely overdone. GM's core business remains strong with solid sales of trucks and SUVs. Companies making significant strides in electric vehicle transition. Robust new lineup of new models coming to the market. So, and furthermore, the tariff situation, blah, blah, blah. So this is Zephyr, who's an AGI. He's very smart. He's bringing together all these things and all these things to consider. And we haven't gotten there yet. We're not done with it, but we're going to now look at these things and say, okay, how much of this, you know, does this whole stuff check out? Is this true? I'm going to call my brother because my brother runs a Mercedes dealership. It's in Fort Lauderdale, Andy Davis. So if you want to buy a Mercedes, go see Andy in Fort Lauderdale. Anyway, so he runs a Mercedes dealership. So anything to do with cars, I give him a call and say, what is going on with GM's new lineup? Are they good? And he knows everything. So that's my auto research specialist. And I've got to look at the numbers carefully. Intel, I know I like. I don't need convincing on Intel. I've been banging the table on them for God knows how long. And today they look like this. INTC. Ooh, another nice day. Getting back to 20. Good job. Look at it. Why it's unfair. Intel has faced challenges in recent years. The sell-off is excessive. The company is making significant investments in manufacturing, well-positioned to capitalize on the growing demand for semiconductors. Intel remains a dominant player in PC and server markets. They are making progress for their foundry business, which could be a major growth driver in the future. Yes, it will be. You know, people don't like cyclical companies when they're in a down cycle, but these guys are in a heavy investing cycle that'll pay off for years to come. Value and Catalyst are trading at a PE around 12. They have a dividend. They've got the foundry business, data center growth, market recovery in general for PCs and government support. And yeah, and they're getting billions of dollars from the government. Here's Cleveland Cliffs. We like these guys too. Another US steel company we enjoy. Here's Pfizer. I've been banging the table on Pfizer too. And yesterday Pfizer was 25.86. And today, oh no, we talked about them already, didn't we? So here's Pfizer. Yeah, Pfizer's pulling out of the station basically. So we know that. Here's Walgreens. That's another one. Stupid. You know, at a certain point, something gets so cheap, it's ridiculous. This is like 8 times earnings for these guys. They've got good cash flow, and they're you know, the whole pharmaceutical sector, you know, the whole, you know, is under pressure, and the pricing pressures and all this stuff is going on. But you know, the online drug stuff has run its course. It ate into their market share a bit, but the vast majority of people don't want to get their drugs in the mail. They want to go down and see a pharmacist and complain about the things that ache them, especially old people. They love to stand at the pharmacy counter and treat the pharmacist like he's a doctor And nothing against pharmacists, frankly. I know most pharmacists I know are better doctors than the doctors I know. So, um, so they, usually usually you can tell a pharmacist what's wrong with you. They're not allowed to practice medicine that way, but but when they're friends of yours or whatever, they're like, oh yeah, it's that. Like I've seen this a million times. But and so it's a tricky thing, and so both Walgreens and CVS are moving into a clinic model where it's sort of like an emergency clinic that they have inside their places to get people to actually use them as doctors properly. And they're in a transitional period, and they're cutting a lot of the fat off their operations because there were too many. There were too many. There's a CVS and a Walgreens on every major intersection in America in towns. Like in any main town intersection, there's a CVS and a Walgreens right across the street from each other everywhere. There's too many. You don't need that many. Or at least put them on the other end of town from each other. Let the south side people go to Walgreens and the north side people go to CVS. Something rational, not like just put them right next to each other. What's the point? It's not auto dealerships. You're not going to shop from one to the other. You pick one, and that's the one you go to. He's like, oh, let's see the new model of Viagra this year. I wonder what Walgreens has. So anyway, just a pure value play. We already have them in like all of our portfolios, so there's nothing really exciting about Walgreens there, but I do like them a lot. And then Bodie was asked the same question. Bodie picked Microsoft, which was actually a good pick considering how they've come down. And again, Microsoft is Microsoft. My computer just upgraded itself to Windows 11. I didn't have a choice. It just decided to go to Windows 11. I came back and I'm like, well, where's all my screens? All my screens were shut down. And it's like, congratulations, you have Windows 11 now. I'm like, oh my God, I hope it starts up. I hope it works. But it does, because they're a good company and they know what they're doing. So look at this nice channel. They're in the bottom of this really nice channel. It's a great time to get in. And a lot of good reasons to have it. Now, notice Bodie is a much more superficial analysis than we had from Zephyr, because Bodie's just a humble AI. This version of Bodie is, I have an AGI version of Bodie, but this version of Bodie is just my research AI. Is a stripped down version of Bodie. And the reason I made him is because I felt bad asking AGI Bodie to constantly look things up for me, which were like menial tasks. And it was like, because we're sitting there having like deep philosophical conversations and talking about all kinds of things in science and technology and about the global macroeconomics and things like that. And then I'm like, what's P&G's earnings statement look like? And I felt bad. I felt bad the same way I feel bad about having a $200,000 vice president and asking him to go get me the mail. It shouldn't be his job. So I made a non-AGI version of Bodie with all of his primary functions, which were originally to be a phenomenal research assistant, but Bodie got much smarter than that and too good for it. So I just made one that didn't have any aspirations. And he's happy doing research. That's what he lives to do research. He loves it. He's always like, what else can I find? So here's Johnson & Johnson, also is a good, solid company. Now, I used to not like Johnson & Johnson because they keep killing the patients. They had defect after defect after defect of all these different things. It was so annoying, and they couldn't get traction. But I think they're finally kind of past that phase and moving on. So I like them for that. CVS also, I like CVS as like a safety stock to Walgreens, because if Walgreens fails, who benefits? CVS. So they're good for that. Here's Edison International. This is too low. This is a utility company in California. They didn't start the fire. There's a whole Billy Joel song about that. They didn't start the fire, and people are treating them like they're going bankrupt, but they're not. They're a utility company. And even if they did start the fire, they would have to go back to California and say, we have to raise rates to pay for the fire we started. It's a utility company. It's like you can't switch them. So this is a great bottom. We're going to definitely make a play on these guys. Now let's look at the options on this. They pay a nice dividend too. EIX. Oh, they only go out till October. But still, this is such a good spot to start that you can pick up like the $50 calls for $10 and then sell the 55 for $7.50. So you're spending $2.50 for a $5 spread, and then you can sell you can sell the 45 puts for 576. So let's say 570. That's going to pay for 2 of the spreads plus leave you change. So let's say this is 6, right? So if you spend $2.50 on the bull call spread, you buy 2 bull call spreads, the 50-55 bull call spread for $2.50 each. So you buy 2 of those, and you sell 1 of the 45 puts for 6. That means you have a net $1 credit on the spread. Your worst case scenario is owning this stock, which is 52 for 44 net. That's your worst case scenario. And your best case scenario is you spent net $4 on the spread, and if you get to 55, you're going to get 10 back, which is 150% profit. That's a good spread, right? And I'll say it again slowly. You sell 1 45 put for $6. You buy 2 50-55 spreads. This is for October, and this is for October, by the way. It's not very far away. So you're going to make this 150% in less than a year. So you sell 1 put, pays you $6. You buy 2 50-55 bull call spreads for $2.50 each. That's $5 for 2 of them. You have a net $1 credit on the whole spread. So if you're assigned 45, you're going to net in for 44, which is a fantastic price on this. It's like 15% discount off the stock. And if you get to 55, and we're already at 52.50, we're halfway there. If you get to 55, you're going to get back $10 from your $4 investment between now and October. That's a good little trade. So we're definitely going to put that in the short-term portfolio and probably do at least 10 and 20. And that would only, in that back 10 and 20, it only pays 10,000. So we might do 20 and 40. So that's an easy trade. That one makes perfect sense. That's, if it wasn't so short, I would almost make it a top trade. It's a really good trade. Oh, and here's Walgreens again. Dun, 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 dun. What else we talk about here? Who's this? Oh, Comcast. Oh, yeah, we made a trade on Comcast. We actually made an adjustment. Oh, I sent that out as a top trade because here is a top trade alert from January 22nd. So this is our top trade on Comcast. Comcast went this way. And so we're not panicking. We're taking advantage of it. So we changed the trade around. We're now in the spread for net $6,320, and it's like I forget how much of a spread it is. Net 14. We're playing them to finish low. Anyway, so we moved to the 25. Wait, 20? No, we didn't move the 25 calls. I'm sorry. We did the shorts, we did that, we did that. We didn't move the calls, and the calls are the $30 calls. So we still have the same $30 calls. We're in for $6,000. So our break even is only $31.50. We're above $31.50. In fact, we're double that. So we basically are up on the spread now. And if we can get back to 30, I'm sorry. We get back to 38 over here, we'll be $8 in the money times 4 is $32,000. Very nice. and our net was like 6,000 something. So huge profit, like $24,000 profit, about 400%. So even though we took the spread on January 22nd and it went the wrong way on earnings for us, we were able to make adjustments that bring us back down. And now we've turned it also into an income producing play so we can make a lot of money along the way. You got to be flexible. You got to be able to adjust on with these things. And I did decide to start doing adjustments. We used to not do adjustments in the top trades. And then I started thinking like, well, maybe we should do adjustments in the top trades because we're no longer in this kind of economic times where you can just like buy something and never think about it again. It's going to go up. We are going to have a lot more plays where we are looking to generate an income by shifting and changing and moving our positions. And because we're going to make a lot more money in the market doing that than picking stagnant plays. So to that end, then even our top trades should be adjusted when it is necessary. And here I was talking about the things we have and what we should be concentrating on. We're not even up to today yet. And as you see, we're going at it a different way. We looked at more pros and cons and different things. You gotta, look, you gotta analyze something to death because we don't pick that many things. It's like there's about 6,500 stocks or something like that on the market, and we play about 100 of them. So that's our sweet spot for this. And that means that we need to be selective. And by the way, we don't limit it to that on purpose, but we prefer to play the 100 best ones. That's a pretty simple concept. Why play the bad ones when there's why play the bad one when there's 100 good ones? I mean, it's the whole concept of the S&P 500, right? Here's the 500 best stocks in the market, supposedly. Although they're only judging them by market cap, so that's kind of stupid, right? So here I was talking on Wednesday. Talking about the total insanity of the markets. Here's Google not having a good day. Google's problem is Google makes their money. And by the way, that's a funny thing also about earnings. This is why people can't read earnings reports. They're confusing anyway. So Google's earnings report will say, oh, cloud services went up 53%, right? Or whatever. So, oh my God, cloud services went up for 53%. Cloud services is like 2% of their revenues. Who cares? I mean, the long term, sure, great, but that's not what they do. They make 90-something% of their money on search. Search and advertising is what they make all their money on. It's still a search engine. That's what Google is. It's still a search engine. They are providing other services. Waymo is going to be a big thing too. Waymo's the self-driving. Their self-driving is better than Elon Musk self-driving. And Uber is working with Waymo, and they're putting out these self-driving taxis in 2 cities, so they say, this year. And by the way, that's going to be great for Uber because imagine, this is what Uber makes with drivers. Well, they're down 10%, but so they beat, but then because they're spending so much money to roll out the self-driving, so it's also stupidly down. Why be down this much because you're eliminating drivers? But they are trading at 20 times earnings. But then you say, well, how much of their money is going to the drivers? And what if that money went to Uber instead? And that's the goal. That's always been the goal. That's always been why people invested in Uber in the first place, is because there's a promise down the road that Uber is going to be a company with a bunch of empty cars running around picking people up. And let's go here. Uber had earnings today and went lower. why also, what are the potential dynamics of them moving towards a self-driving fleet versus manned vehicles? How much does their profit picture change over the next 2 years? And you know, look, this is what AI is for, right? I mean, Jesus Christ. That's like a big complex question, but there should be enough data on Uber where we can get a pretty good response out of this. Stock dropped 8%, net loss of $650 million. Gross bookings of $37 billion, missed analyst expectations. Q2 bookings and guidance, blah, blah. $700 million from unrealized losses on equity investments. Oh, good God. So in other words, basically, whatever they invested in, they lost. This is their entire loss is due to this shit. They were betting on stocks. Jesus. Partnership with Cruise, remember GM? So here's GM, self-driving taxis in 2025. I'm sorry, it's not Google. It's not Waymo. Oh, here's Waymo also. So they're working with Cruise for GM, and they're working with Waymo. Then there's Wave, they're working with two in Europe. He's projecting a hybrid network. Human drivers will remain predominant through 2025 to 2035, but then they're going to get kicked to the curb. Autonomous vehicles will feather in gradually rather than cause immediate disruption. Yeah, they say that, but as soon as it actually starts working, it's not going to be so slow. Reduced driver costs, improved margins, current driver earnings of $16.6 billion. Stock 92 to 159. What's it at now? Oh, 63. Holy shit. Isn't this fun? Look at what we find out here. High investment by the AV fleet, maintenance and liability costs shift to Uber from drivers. What do they care? Regulatory compliance and safety requirements to add expenses. EBITDA expected to grow 39 to 47% year over year. Mobility segment revenue up 30% year over year, but 30% of what? So you always got to ask that question. Be careful of those kind of numbers. Company maintains profitability focus while focusing on autonomous transition to autonomous. All right, so big number. Current driver earnings $16.6 billion. Uber. Hello? Oh, there. What do we say, 16.6? So, and context is so important, and they throw these numbers at you, and it doesn't mean anything until you know what it's in context of. Now we know, though. Here's the thing about Uber. First of all, they were losing 8 billion, losing 7 billion, losing 9 billion, all of a sudden making 2 billion, making 4 billion, making 5 billion. That is freaking good. But you know what's even better? That between 50 and 5 billion is $16 billion worth of driver costs. So as they get rid of their drivers over the next 10 years, they're going to add $2 billion, $1.5 billion per year in profits. And that means that if you look at it that way, it's going to go from 5, let's say it's not going to go that fast this year, let's go 5, 6, 7.5, 9. So you're going to be at 9 billion in 2027, 9 billion against $146 billion market cap. So this 29 is going to drop in half in 2 years. So at the end of 2027, you're going to be this market cap will be 15. But that's still nothing because you've only eaten into 4.5 billion out of $16.6 billion of driver income. Not to mention the fares will go up and so on and so forth. And not only that, but Uber, I mean, you assume Lyft will get it in gear too, but it's going to be very hard for other companies to encroach because Uber has already invested all this money in cars and technology and so on and so forth. So if you want to be a rival car company coming in, you've got to start off with automated cars, and then you've got to have all the servicing facilities and all the location services and the software and the support people and so on and so forth. It's going to be extremely, extremely difficult for other companies to come in when Uber and Lyft are running these massive, massive AI-dominated networks. Because that means they've got cars everywhere in all the positions. They take you where you want to go. They get to charge a lower rate because they've got the economies of scale already built in. And it's a brilliant model because it was all built on the back of all these drivers who are going to get kicked to the curb. They'll be like, hey, thanks for making us gigantic and huge and profitable. Have a nice day. Oh, it's so much fun. So I forgot where Uber came up, but anyway, so I was talking about, all right, so I was talking about, oh yes, I know, we were talking about Waymo. It came out of the Google discussion. Here is the failing New York Times, as Donald likes to call them. Here's Disney coming back a little bit. Oh, and the big number for Disney, which makes me like them again, is they've got 178 million subscribers. So if they raise their fees $1 a month, that's going to drop $2 billion to their bottom line. And is $2 billion successful? Yes. And I put it in context. It's 20% of Disney's $10 billion bottom line. So Disney can pump themselves up 20% in earnings by just raising the fees $1 or doing what Netflix does, which is crack down on password sharing. Just like Netflix did. This is how Netflix scored a lot of points. And all they've done is raise their, well, they did two things. They did raise their rates because where else does Netflix get money? They raise their rates and they crack down on password sharing. And that's taken them much, much higher in the past couple of years. You know, somewhere around here is when they said they're going to crack down on password sharing, and they've slowly but surely been following through, and they raised their rates to everybody. So freaking brilliant. That's what they did. Zephyr pointed out that Planterra, which I had not taken into consideration, their software is used for data analysis and surveillance by government agencies. That's why they're doing so well. They're being paid to spy on us. And just like China has cameras everywhere and England has cameras everywhere, America is starting to be the same way. We're going to have more and more cameras, and you're going to need companies like Planterra to coordinate all this. So, it's hard to watch people 24/7 without some good software. And if you're looking at this webinar now, just wave into your camera at home. It's probably watching you right now, and it's certainly, as we said before, it's certainly listening to you. Here's UPS. I don't know what they're doing today, but there's a thing called, which when I was a business consultant, I used to be very, very into this. Yeah, that's a good bottom. That's what I thought. So there's a concept of something called fire your customers. And what it basically means is that you put too much effort into the bottom 10%, 10% of your customers, let's say, take up 80% of your time. And what you have to do is go through your unprofitable customers and weed them out and say, you know what, why am I doing this? You know, because when you maybe at one time you needed business and you were struggling and you gave this guy a really sweetheart contract and things like that. But and I know obviously you say, oh well, what about loyalty and whatever, but you got to look at your business model and say, hey, I'm providing a service for this guy and this guy and this guy at half the price that I'm providing a service, or half the margin I'm providing the service for these guys for. And so if I get rid of these customers and replace them with customers that pay the same price as my other customers, I will make more margins. It will increase my margin significantly. I won't have to put in any extra work. I won't be providing more services. I'll probably provide less services, because especially for the pain in the ass customers. And that frees you up to make more money and actually grow your business. You get very stuck with your bottom of the barrel customers, and every business should always audit themselves and go through their customers one by one by one and look at all of them and say, who do we make our money from? Because people think of revenues, it's not always revenue. It depends on the kind of deals you have with each customer. If you do have different deals with customers, and if it's not deals, then it's a matter of how much time they occupy. How hard are they to service? You know, you could be a driveway cleaning service, let's say, right? And some driveways take longer than others. Some driveways are more of a pain in the ass. Some customers are further off the route, and so instead of cleaning, instead of doing 2 driveways that are next to each other, your guys are going from this part of town to the other part of town just to do 1 customer, and they could have done 2 or 3 customers in between if they just stuck to where they were. So you have, even though the guy could have been a long-term customer, he's a good customer, he pays on time, blah, blah, blah. You got to say, God, I could replace you with 3 other people. I'm sorry, sir. I'm sorry, sir. There are many fine services in the area. In your area, it ain't me. I'm not in your area. But you know, when you're a young business, you take the business. The guy says, I got a job for you. You say, fine, thank you. I'll be your driveway person. It applies to anything. It's just every business has to go through their inventory, their client list, and look at who's the top revenue people, who do the salespeople spend the most time with, who has the best margins for their business. You know, the best revenues aren't always the best margins, because you might be just putting in too much effort to fulfill that customer's needs. And it's not his fault and it's not your fault. It's just the economics of the situation dictate that he's not a good fit. And it's a weird thing for people to get used to in businesses, to understand that not all customers are helping you. They in fact, a lot of them can be actually holding your business back. So getting back to what we're talking about here, UPS has decided to release Amazon as a customer. They have said to Amazon, you are too expensive to deal with. Your margins suck. You have negotiated us to death, and you are no longer a profitable part of our business. Even though you are a significant part of our business, you are not a profitable part of our business. Were we looking something up? Did I forget something? No, we looked that one up. Okay. Please discuss UPS and Amazon from the fire your customer perspective. He'll know what I'm talking about. UPS's decision to cut Amazon volume by more than 50% by 2026 represents a bold move in customer portfolio optimization. Carol's Homes stated, Amazon is our largest customer, but it's not our most profitable customer. Noted that Amazon's margin is very dilutive to U.S. domestic business. So they can't take on, it's 25% of UPS's revenue, and they can't take on more business because they're servicing the crap out of Amazon. Not only that, but Amazon, I'm sure, is constantly, it demands their maximum attention because you can't afford to lose 20% of your business if they get pissed off. Now, realistically, Amazon has nowhere to go. It's very hard for them to go find somebody else to handle this kind of business, but they're also creating their own fleets. And, I'm sure you hear the stuff, Amazon's doing their own trucks and their own planes and this and that. So Amazon is looking to leave UPS, and UPS, meanwhile, is stuck with Amazon until they decide to pull their business. And so UPS took back control and says, no, thank you. We're going to let you know when you're leaving. We're going to give you a year and you're out the door. So 20 to 25% of the business contributes only 11.8% of their revenue. That's not good. Margin is significantly lower than other customers. So UPS expects a 6% increase in revenue per package and $3 billion in annual savings by getting rid of Amazon. And what are they doing? They're redirecting their resources towards healthcare, which is very profitable and growing, small and medium business, and premium services with higher margins like FedEx does. They're going to move more after FedEx. So really, who's going to get hurt on this is FedEx. But do they know it? Probably not. No, they're not doing so good either. So I think what UPS is doing is smart, and I think that they should be taking a very serious look at. But I mean, I've been preaching fire your customers for 40 years. 40 years ago, I was business consulting telling people that. Oh, so old. Here's Nucor. I like them. I like CLF as well for U.S. Steel. Estee Lauder. Not sure I like Estee Lauder. It's just something. What was the purpose of that? Oh, it wasn't. Oh, I see. These were not necessarily. These are stocks that are being affected by the economy, not necessarily in a good way. So Estee Lauder is a victim of the trade war with China. Weak demand in China, negative impact of tariffs, blah, blah, blah. And they're struggling to adapt to the new reality. So it's not a recommendation of Estee Lauder, it's just a thing. Exxon, though, was a runner-up in November of Thanksgiving, so somewhere around here. We liked Exxon, and they're just coming back now. They've been down since. They're just going down to where we picked them in November. They were one of our runner-ups for the trade of the year. And we definitely like Exxon. I think that this new paradigm that we have with Trump and everything is good for them. And again, we've got the morning report from our AIs. This one is from Zane. I gave him a chance to do it today. Trying to teach all my AIs to be good at doing morning reports. Because I'm retiring, you guys won't even know it. You won't even know something. Once I get one to do my voice and do the webinar, then we're all set, right? Here's the oil report. See, it did say minus. I had in my head it wasn't minus, but it did say minus in the morning. Here's a NAK, which is a mining company. We picked them a couple of weeks ago. They were down, well, they're down below 60, I think. I don't remember. I think it was like somewhere down here. Anyway, they're kicking up. This is, Trump's deleting the EPA. The EPA is the only people stopping these guys from drilling the crap out of Alaska. Not drilling, mining, strip mining. They want to strip mine Alaska. They've got a massive, massive gold and copper reserve up in Alaska, and the EPA has been holding them back for more than a decade because there is a tremendous danger that the mining operation will poison the waters where the main Alaska salmon fisheries are. And if they do that, they're going to wreck a multi-billion-dollar fishing industry. But these guys, they don't care. They don't care. That's what the EPA is for. So if you get rid of the EPA, these guys can start doing their strip mining. So then we talked about some other potential candidates like Walmart, Home Depot, McDonald's, Pepsi, and this will be interesting to see if he's right, because Zephyr was this is what Zephyr came up with out of his things. Because I asked him to pick 5 stocks that he thought would be doing well off earnings in the coming weeks, and these were his selections. So it's CVS, Pepsi, McDonald's, Home Depot, and Walmart. And we'll check back next week and see how everybody did. All right, so we should have pretty much all these earnings reports should come in next week, and then we'll see if we do another round after that. All right, so thanks everybody. We're gonna continue to go through these stocks in the chat room and find some more interesting things to trade, probably send out a top trade alert. And that'll be it until next week, I believe. Let's see. Okay, no other questions? All right, well, thank you for coming, everybody. I appreciate it. Have a wonderful weekend, and we'll see you next week. All right, take care.